I'm Sebastian St. James, or Sebastian Sir James, as YouTube has been subtitling my videos. Finally, I've got recognition. I've got a knighthood from YouTube. As a popular Australian finance specialist, I'm constantly inundated with questions. Including fees and dividends reinvested, does NDQ still outperforms IVV? Okay, well this is how it works. Would be great if you could do a comparative video on the best ETF AU versus world. Sure, I can do that for you, no problems. Let's start. Could you please do a video about the best dividend ETFs in Australia? Best ones. Okay, let's go. Would you do one on gold and silver investing in Australia? The pros and cons versus share market crypto investments during these economic volatility of high inflation and rising interest rates. Oh, so many questions. If only there was a way, a magical way I could cope with all these questions. In a previous video, one of my viewers, James Taylor, said, you should do a video on using ChatGPT for investing advice. That's it! Today, I'm turning my channel over to artificial intelligence. It will answer your questions that you've actually submitted to this channel. We'll see how it goes. These are the rules. I'll look at the answers that the AI gives me for your questions. If I'm happy with the answers, tick. Job done. If I'm not, we will revisit that in a future video. So, question number 1, AI, are your circuits ready? Including fees and dividends reinvested, does NDQ still outperforms IVV? The AI says, I'm unable to provide you with specific answers to whether NDQ, the Nasdaq 100 index, outperforms IVV, the iShares Core S&P 500 ETF, including fees and dividends reinvested, as this will depend on the specific time period you're looking at and the performance of the individual components of the index during that time. It is important to note that past performance is not indicative of future returns, and it's always a good idea to consult your financial advisor before making investment decisions. That little financial disclaimer is going to be on all the AI's responses, so I'm not going to read it out every time. I don't feel it's actually answered Black Shirt's question. It's a bit of a cop-out. Oh, which outperforms? Well, I don't know. Depends on your time frame. Technically, this is correct, but I don't think it's answering the spirit of the question. Surely the answer should be, well, as much data as you can get, which outperforms. So that I will come back and address in a future video. So if you buy an ETF that entirely holds another ETF, does that mean you're paying fees on fees? For example, if you were to buy Australian IVV, which just holds the American ETF, does the Australian ETF take its fees before paying the Australian ETF, which in turn takes its fees before paying me? What an excellent question. Thankfully, I don't have to answer it. If you purchase an ETF that holds another ETF as one of its underlying investments, you would be paying fees on both the underlying ETF and the ETF that holds it. This is known as double dipping on fees. When an ETF holds another ETF as an underlying investment, the underlying ETF will take its management fees and other expenses out of the returns it generates before passing on the remainder returns to the ETF that holds it. The ETF that holds the underlying ETF will then take its own management fees and expenses out of the returns it receives before passing on the remaining returns to its investors. The AI is absolutely correct. That's exactly how it works. And that is why the IVV in Australia is actually more expensive than the one in the US. But what I will tell you that the AI has left out is that the quoted management costs that you get in Australia, like the 0.04%, that's it. That includes any underlying American fees. So it is fees on top of fees, but it's not separate hidden fees on top of the fees that they quoted. What they quote is all their fees. Well, it should be, in theory. Just came across your videos and really enjoyed this video. Very informative. Would be great if you could do a comparative video on both ETFs, AU versus the world. We've already had this question. We've answered part 1, which is the best ETF in Australia as far as dividends is concerned, as far as performance is concerned, but I've not yet done the world part, so part 2. So I thought I'd open this up to the AI to see what it came up with. Dividend ETFs are a type of exchange-traded fund that aims to provide investors with a regular income stream by investing in companies that pay dividends. Some popular dividend ETFs in Australia include SPDR S&P ASX Dividend Opportunity Funds, DJND, and the iShares S&P ASX Dividend Opportunities Fund, IHD. Both of these ETFs invest in a diversified portfolio of Australian companies that have a history of paying dividends. When it comes to dividend ETFs globally, some popular options include the Vanguard High Dividend Yield ETF, VYM, and the iShares Select Dividend ETF, DVY. Both of these ETFs invest in a diversified portfolio of companies from around the world that have a history of paying dividends. DJND. That's a new stock code to me. I've just recently done a video about comparing all the dividend-paying ETFs in Australia. Not once did I mention that. Does it actually even exist? I decided to Google it. Well, here it is on the ASX, DJND. Does that exist? No, nothing comes up at all about that. Even Google thinks it's a mistake. So rather than just using the stock code, I'm going to put in the full name and see what Google comes back up with. And here it is, the ASX Dividend Opportunities Fund, and I've included the stock code there. Oh, it comes up with an answer, the iShares S&P ASX Dividend Opportunities ESG Screened ETF. But if you have a look at it, it's the IHD. It is an Opportunities ESG Screened ETF, that part is correct. However, iShares is BlackRock, whereas State Street is SPRD. So, totally different companies. Does this mythical ETF even exist? I don't know. I certainly can't find it. What do I think about the AI's response in general? It certainly did talk about different ETFs and discuss them and compare them, but it didn't give me reasons for why it's the best choice. Would be great if you could do a comparative video on the best dividend ETFs AU versus the world, the best ones. So while some ETF names were bandied about, there's no evidence that any of these were the best, and therefore I will come back and revisit that question. Would you do one on gold and silver investing in Australia? The pros and cons versus the share market, crypto investments during these economic volatility of high inflation and rising interest rates. Wow, let's see how the AI goes about that. Sure, I can provide you with some general information on gold and silver investing in Australia, as well as the pros and cons of these investments compared to investing in the share market or cryptocurrency. I'm impressed so far. One of the main advantages of investing in gold and silver is that their prices tend to move independently of other assets, such as stocks and bonds, which can provide a level of diversification to your portfolio. Additionally, gold and silver are tangible assets, which means that they can be held in physical form and stored in a safe place, if you're into that sort of thing. Their historical track record as a store of value and hedge against inflation and economic uncertainty makes them a popular choice for investing during times of economic volatility, high inflation and rising investment rates. In Australia, you can invest in gold and silver through exchange-traded funds ETFs such as Spider Gold Shares ETF GOD and iShares Silver Trust ETF SLV, or you can purchase physical gold and silver. Wow, and keep it behind your dressing table. On the other hand, investing in the share market or cryptocurrency can be more volatile and may be more susceptible to economic conditions. Share market investing can provide potential for higher returns, but also can carry a higher level of risk. Cryptocurrency can be considered as highly speculative investment, and their prices can be extremely volatile. Mind blown. What an excellent answer to that question. 2 thumbs up, AI. Question answered. Another great vid, Seb. Any chance you could share with me your thoughts on BXB as a mid to long-term hold? To be honest, I don't think much of them, but I'm holding. BXB is the ASX code for what? Brompton Funds Limited, which is a closed-end fund that aims to provide investors with exposure to a diversified portfolio of high-yielding, undervalued securities. No, it's not. BXB is the code for Brambles. It has been for decades. Here, there's proof. That's what it is. Brambles. This question has definitely not been answered. What was the AI even thinking? Sebastian, loving your videos. They are all very informative. I was wondering if you could mention in one of your videos about local producer markets and what are their requirements for operating a stall selling your handmade items, products. Is an ABN needed, and do you pay tax for selling from a public setting? Thank you. To sell your handmade items or products at a local producer's market, you will typically need to apply to be a vendor at that market. Each market has different rules and requirements for vendors, so it's important to research the specific market you're interested in and understand their requirements before applying. In most cases, you will need to have a valid ABN, Australian Business Number, to operate a stall at a local producer's market. An ABN is a unique 11-digit number that identifies your business to the government and to other businesses. It allows you to claim GST credits, but it's important to check with the market organisers if they require it or not. When it comes to taxes, if you're selling handmade items or products as a hobby, you may not be required to register for GST and may not be required to pay tax on your sales. However, if you're operating your sales as a business, you will be required to register for GST and you will be required to pay tax on your sales. It's important to consult with an accountant or a tax professional to understand your tax obligations when operating a stall at the local producer's market. Additionally, it's important to check with market organisers if they require you to have insurance and if they provide an insurance coverage for vendors. Again, mind blowing. A perfect answer. I think franking credits were designed by accountants. Can you explain how they work on my tax? Love your work. Look, I can, but today that's the AI's job. Franking credits, also known as imputation credits, are a feature of the Australian tax system that allows companies to pass on benefits of corporate tax paid to shareholders in the form of credits. These credits can be used to offset the income tax liability of the shareholder. Here's how it works. When a company pays corporate income tax, it receives franking credits for the amount of tax paid. The company can then attach these franking credits to dividends it pays to shareholders. When shareholders receive dividends, they also receive franking credits, which they can use to offset their own income tax liability. For example, if a company has paid a corporate income tax of 30% on its profits and it pays a dividend to a shareholder, it can attach a franking credit of 30 cents for every dollar of the dividend. The shareholder will receive the dividend along with the franking credit and can use the franking credit to offset their own income tax liability. If the shareholder's marginal tax rate is lower than the company's tax rate, which is 30%, the shareholder would receive a refund for the difference, known as the refundable franking credit. It is important to note that the franking credit system is designed to prevent double taxation, where profits are taxed at the corporate level and then again at the individual level where dividends are paid to the shareholder. It is also designed to ensure that shareholders are not penalised for holding shares in companies that pay high levels of tax. Bang! Question answered. Totally agree with the answer. So the ASFA standard says less money required as a senior sit, but the Gov mandatory minimum super drawdowns increases. There is a mismatch. That kind of sounds like you need context, as if it was a comment to a specific video and there's kind of parts missing out of the question. But let's throw it over to the AI anyway and see how it goes. The Association of Superannuation Funds of Australia, ASFA, provides retirement standards that are intended to provide guidance on the amount of money required to support a comfortable lifestyle in retirement. These standards take into account factors such as the cost of housing, healthcare and other expenses. On the other hand, the government's mandatory minimum in superannuation drawdown is a rule that applies to retirees who are receiving an income stream from their superannuation savings. It requires retirees to withdraw a minimum amount each year from their superannuation account, starting from the year when they reach their preservation age. Okay, that part's not true. You can reach preservation age at 60. However, you'll still be working through to 67 to get the pension, and you do not have to draw down from the age of 60. The purpose of the mandatory minimum drawdown is to ensure that retirees use their superannuation savings during their retirement rather than leaving it untouched in an account. The ASFA standard of the government's mandatory minimum drawdown may appear to be mismatched because they are based on different principles and considerations. The ASFA standard is based on the idea of providing a comfortable lifestyle in retirement, while the mandatory minimum drawdown is based on the idea of ensuring that retirees use their superannuation savings during their retirement. It is important to note that the ASFA standards are not legally binding, no, they're certainly not, and are intended to be used as a guide, while the mandatory minimum drawdowns is a legal requirement. An excellent answer. Hi Sebastian, what do you think about the ETF AC/DC? I think they're an excellent band. In particular, my brother absolutely loved them. Oh, not your question? Do you have any suggestions for EV lithium ETF? The ETF AC/DC is an actively managed fund which aims to invest in the companies that are expected to benefit from the growth of electric vehicles and lithium, as well as other metals that are used in the production of batteries, such as cobalt, nickel and graphite. The ETFs hold a diversified portfolio of companies from around the world that are involved in the production and supply of these metals, as well as companies that are involved in the production and supply of electric vehicles. When it comes to ETFs that focus on electric vehicles and lithium, some popular options include the Global X Lithium and Battery Tech ETF, LIT, and the Global X Autonomous and Electric Vehicles ETF, DRIV. LIT Fund aims to provide investors with exposure to lithium mining and battery technology industries, while DRIV aims to provide investors with exposure to companies involved in the development and production of the autonomous electric vehicles. That's a pretty good answer. The only query I have that is when it talks about AC/DC as being an actively managed fund. When I've looked at it, we see the objective is the Global X Battery Tech and Lithium ETF, which is AC/DC, is based on the Selective Battery Value Chain Index. So if it's exactly as it's stated, then it's not actually an actively managed ETF. It's based on an index. It's not a market cap weighted index, but it is an index anyway. And if it's exactly like it's stated, then it's actually a passive ETF. But other than that, I think it's generally a good answer. A number of ETFs were discussed that fit the bill. Thank you for the excellent video, Sebastian. Do you think you will make one about investing in Chinese ETFs? That would be interesting too. It would be interesting indeed. But let's see what the AI has to say about this. Sure, I can provide you with some general information on investing in Chinese ETFs. An ETF is an exchange-traded fund that aims to provide investors with a convenient way to gain exposure to a diversified portfolio of Chinese companies. Some popular Chinese ETFs include the iShares China Large Cap ETFs, FXI, and the SPDR S&P China ETF, GXC. These ETFs invest in a diversified portfolio of large-cap Chinese stocks that are listed on either the Shanghai or Shenzhen Stock Exchange. Additionally, there are also ETFs that focus on specific sectors of the Chinese economy, such as technology and consumer discretionary. Examples include the CraneShares CSI China Internet ETF, QWEB, and the CraneShares MSCI China Consumer Discretion ETF, KCCD. Investing in Chinese ETFs may provide investors with the opportunity to gain exposure to the growth potential of the Chinese economy and its companies. However, it is important to note that investing in Chinese ETFs also carries some risks. The Chinese economy and its stock market can be subject to significant volatility, and the regulatory environment in China can be complex and difficult to navigate. An excellent answer. China has huge regulatory risk. See what it's doing with its tech companies at the moment. So, investing in China is speculative, highly speculative. And our next question, too many requests in 1 hour. Try again later. Apparently, I've used up the entire world's worth of AI technology in one video. But that was a fascinating journey into the mind of the AI. A lot of that is very, very impressive. And it allowed me to get through a whole lot more questions that would have taken me months to do an entire video on for each of those questions. I think, well done. Do you know that dividends are affecting your index funds? How so? Click here to find out. Or if you watch that, click here.